I think that's true. What the BIS did to undermine their progression, I think, was a rallying cry that that won't be underestimated, or shouldn't be underestimated. And when it's all said and done, it will be looked back upon as kind of the turning point for the acceleration of what they're doing. First of all, let's talk about gold accumulation. The central banks have doubled down their purchases in gold over the last several months. In November and December, or October, November, the last 2 months, I'm not sure if December came up yet, but their numbers were twice the 12-month moving average. One of the things that I find interesting is that China and Saudi Arabia have both been caught recently importing gold that they did not report to the IMF. China said they stopped buying gold. They hadn't done that. In fact, there was an estimation that was this came out on several news sources saying that they said they bought 5 tons. Recently, they think it's 55 tons, 10 times underestimating what they said. The import-export numbers caught both Saudi Arabia and China importing gold through the UK and Switzerland. They never reported it to the IMF. Sorry, it was a mistake, more or less. And as we've talked about ad nauseum, China, when they buy gold through the People's Liberation Army, or when they buy gold that is not 999 pure, it's not reported to the IMF. And I'll get to that in a moment. When the proxy banks, the commercial banks, buy on behalf of the PBOC, it's not reported to the IMF. But when you talk about what China has been doing, they've been flying all around the world, buying doré and concentrate from the miners directly, disintermediating the market. They're not telling the world how much they're buying. They're purposely being private, and they're purposely being opaque, and they are purposely not being transparent. Although they've been caught a few times, they're the largest producers, they're the largest importers, they are a net importer, they have an insatiable appetite for gold. It's just beginning. And so we can continue to talk about how much gold the central banks are buying, but it has not stopped. The IMF says that central bank gold holdings have gone up to 1.16 billion troy ounce and growing. And they're the largest holders of gold on the planet. They understand this. The trend for this to continue, it's not stopping. When we talk about BRICS, you have, I guess I would call it a shadow supply chain, not just in gold, but also in silver. They're bypassing the traditional markets. They're buying doré and concentrate. In fact, 75% of all the industrial silver they're using now is coming from concentrate. It's a sludge that the miners have, and they scoop up the sludge. They sell it for pennies on the dollar. China's paying double what the West will pay and refining it back in China. And so this is the second largest producer of silver in the world, a net importer, buying gold directly from the miners in South America to disintermediate the marketplace. No one has any idea how much they're buying. This is going to be the new trend. Because of what the West did, because of what BIS did, and in essence at the 12th hour embarrassed them and pulled out and called out Russia as someone that they could not be part of this new cross-border payment plan with, when it was developed in their innovation hub 4 years ago with these countries. It's criminal.
The current gold rush led by central banks, particularly from the BRICS nations, Brazil, Russia, India, China, and South Africa, is far more than a tale of accumulating shiny metal. It's a calculated response to decades of Western monetary dominance, an effort to reshape the financial landscape by hedging against currency depreciation, economic instability, and geopolitical tensions. Andy Schectman's insights provide a glimpse into the covert strategies employed by these nations and their ramifications for the global economy. China and Saudi Arabia have been particularly aggressive in acquiring gold, often circumventing traditional reporting mechanisms like the IMF. By not disclosing their full purchases, they maintain strategic opacity, shielding their moves from prying eyes in the West. A recent report highlighted how China's official declaration of purchasing 5 tons of gold was a gross understatement. The actual figure was estimated to be 10 times higher, around 55 tons. Saudi Arabia has employed similar tactics, importing gold through intermediaries in the UK and Switzerland without proper documentation. This secrecy extends to how China sources its gold. Instead of buying on open markets, it often deals directly with miners, acquiring doré, semi-pure gold, and concentrate at favorable rates. These transactions bypass traditional market mechanisms, enabling China to accumulate reserves quietly. The People's Liberation Army and state-owned banks often serve as intermediaries, further obfuscating the scale of their acquisitions. This covert behavior signals a broader strategy to shield their economic policies from Western scrutiny. Central banks worldwide have doubled their gold purchases in recent months, with October and November showing acquisition rates twice the 12-month moving average. The IMF estimates that global central bank gold holdings have risen to a staggering 1.16 billion ounces. This accumulation isn't coincidental. It reflects a growing recognition of gold's enduring value as a hedge against currency depreciation and geopolitical instability. Gold's appeal lies in its immunity to counterparty risk and its historical performance. Since 2000, gold has outperformed U.S. Treasuries by 180%, particularly since 2008. For central banks, holding gold is about more than just diversifying reserves. It's about preparing for a world where the U.S. dollar is no longer the uncontested global reserve currency. The BRICS nations are leading a quiet revolution against dollar hegemony. Collectively, they account for 15% of the world's gold reserves, 30% of its landmass, 40% of its population, and 54% of global GDP. These statistics underscore their capacity to influence global trade and finance significantly. One of the most notable shifts is the declining share of U.S. dollars in global foreign reserves, which has fallen to 57.4%, its lowest level since 1994. This trend is accelerating as BRICS countries increasingly settle trade in local currencies, reducing their dependence on the dollar. China and India, for example, have ramped up local currency trade agreements, bypassing the need for dollar settlements. The BRICS nations are not just accumulating gold, they are integrating it into a new financial infrastructure. This includes systems like BRICS Pay and BRICS Bridge, designed to facilitate cross-border payments. These platforms utilize a unit settlement token backed by 40% gold, providing a stable and transparent means of settling international transactions. Gold-backed tokens offer several advantages. They reduce reliance on fiat currencies, mitigate exchange rate risks, and enhance trust among trading partners. By incorporating tokenized gold into their payment systems, the BRICS nations are laying the groundwork for a more equitable and decentralized financial order.
So now everything that you see is going to be more and more and more opaque. We see 9 new countries that have joined as their partner country. They're not a full member, except one of them became a full member, and that's Indonesia, the largest holder of nickel in the world in the ground in Indonesia. Their president, Widodo, has called for an OPEC-style cartel of rare earth metals. Almost all of them are mined or found in the Eurasian continent. And this is something that, again, it's only going to get worse because 100% of rare earths are refined in China the last few years, and the majority of it are mined in these areas. But you have Belarus, Bolivia, Indonesia, who is now a full member, Kazakhstan, Cuba, Malaysia, Thailand, Uganda, Uzbekistan. As it is right now, they hold 15% of the world's gold reserves, 30% of the world's landmass, 40% of the world's population, and 54% of global GDP. Not to mention, they control the majority of the strategic routes on sea and many on land. They're growing. And when you look at the foreign reserves that these countries hold, the dollar share of foreign reserves has dropped to 57.4, the lowest since 1994. So they're continuing to shed dollars, they're shedding treasuries, and they are buying gold, which has doubled the performance since 2000. It's up 180% over treasuries since 2008, and it has no counterparty risk. And that's something that's going to continue. Let's see if I have anything else here. Here's some more. Again, we're seeing this massive shift away and settlement by these BRICS countries outside the dollar, and they're using, which will be BRICS Bridge and BRICS Pay. BRICS Pay is a system that will allow cross-border payment very seamlessly for consumers, for B2B. And BRICS Bridge will use the unit settlement token. They're going to use it, which is a 40% gold-backed token agreed upon in principle. According to Dilma Rousseff, the head of the BRICS New Development Bank, the former president of Brazil, we have agreed in principle to the new BRICS settlement, and it won't be a common currency. They will all trade with one another in local currencies, as we see increasing settlement in local currencies, but any net settlement balance will be settled in gold, and they will do it through the deliverable mechanism of the bridge. And they're talking a lot about tokenizing gold to have that trade across BRICS Pay and across BRICS Bridge. All of these things will massively undercut the demand and the need to hold U.S. dollars and the need to hold U.S. treasuries. So that's happening as well too. This is all happening fast. It's something that I think underestimating will be a very big mistake.
The growing accumulation of gold by BRICS nations and their allies signals a seismic shift in global finance. This transformation isn't merely a financial strategy, it's a calculated geopolitical maneuver with implications that stretch across economies, trade, and governance. Andy Schectman aptly underscores that ignoring these shifts would be a critical oversight, particularly for investors and policymakers alike. The dollar's dominance as the global reserve currency has long been a cornerstone of U.S. economic power. However, cracks in this system are becoming increasingly apparent. The aggressive de-dollarization efforts of BRICS nations are more than symbolic. They represent a deliberate attempt to weaken the dollar's grip on global trade. For decades, the dollar's reserve status has allowed the U.S. to run massive deficits with minimal consequences. Foreign nations eager to hold dollar reserves absorb this debt by purchasing U.S. Treasury securities. This dynamic is shifting. As BRICS nations and others trade in local currencies and create alternative financial systems, the demand for U.S. debt declines. This not only raises borrowing costs for the U.S. government, but also undermines its ability to project economic influence globally. Take, for example, the rising trade conducted outside of the dollar. In 2022, China and Russia executed record trade deals in yuan and rubles. India and Brazil are following suit, experimenting with mechanisms for direct currency exchanges. Such moves signal the acceleration of de-dollarization, a trend that could fundamentally alter the structure of global finance. The BRICS nations are not content with simply reducing their dependence on the dollar. They are actively building alternatives. Two critical components of this new financial ecosystem are BRICS Pay and BRICS Bridge. These systems allow for seamless cross-border transactions using local currencies or gold-backed tokens for settlement. What sets these platforms apart is their integration of gold into the payment process. By leveraging tokenized gold as a reserve asset, BRICS nations can foster trust and stability in international trade without relying on fiat currencies. This development is particularly significant given the volatility of global currency markets and the growing mistrust of Western-dominated financial institutions like the IMF and World Bank. Gold-backed tokens offer several advantages. They reduce counterparty risk, a major concern in traditional currency transactions. They also provide a stable store of value, immune to the inflationary pressures that plague fiat currencies. Furthermore, they enhance financial sovereignty, allowing nations to transact without relying on foreign reserves or intermediaries. The implications are profound. If the BRICS nations successfully implement this gold-backed framework, they could set a precedent for other countries, fostering a more decentralized and equitable global financial system. Gold's resurgence is not just a financial phenomenon, it's a powerful geopolitical tool. For nations like China and Russia, gold represents a means of insulating their economies from Western sanctions and financial coercion. By holding substantial gold reserves, these nations can stabilize their currencies and maintain liquidity even in the face of economic isolation. The strategic importance of gold was evident during the Ukraine crisis. As Western nations imposed sanctions on Russia, including freezing its dollar reserves, Moscow turned to its gold holdings to stabilize the ruble. This move not only mitigated the impact of sanctions, but also showcased the limitations of fiat-based economic warfare. Gold's universality further amplifies its appeal. Unlike fiat currencies, which are tied to the economic policies of individual nations, gold is a global asset with intrinsic value. This universality makes it an ideal medium for international trade, particularly among nations seeking to reduce their dependence on the dollar. While gold often takes the spotlight, silver is quietly reclaiming its place as an essential monetary and industrial asset. Known as gold's little brother, silver offers unique advantages due to its dual role. On one hand, it serves as a monetary metal with historical significance. On the other, its applications in renewable energy, electronics, and medical technologies ensure robust industrial demand. Currently, the gold-to-silver ratio remains significantly above historical norms. suggesting that silver is undervalued relative to gold. This discrepancy creates a compelling investment opportunity. As the demand for silver continues to rise, driven by both industrial use and monetary policies, its price is likely to experience significant upward pressure. One area where silver could play a transformative role is in gold-backed digital currencies. These systems may incorporate silver, leveraging its liquidity and lower cost to facilitate smaller transactions. For investors, this trend underscores the importance of diversifying into both gold and silver. The seismic shifts in global finance present both challenges and opportunities for individual investors. The decline of dollar hegemony and the rise of gold-backed systems necessitate a reevaluation of traditional investment strategies. Here are some critical considerations. Focus on physical assets. In an era of financial uncertainty, physical assets like gold and silver offer unparalleled security. Unlike stocks or bonds, which are subject to market volatility and counterparty risk, precious metals provide a tangible store of value. Diversify across markets. As BRICS nations rise in influence, their financial systems and markets offer new investment opportunities. Consider diversifying into assets tied to these economies, such as gold mining stocks or local currency bonds. Prepare for inflation. The ongoing devaluation of fiat currencies underscores the importance of inflation-proof investments. Gold and silver have historically served as effective hedges against inflation, preserving purchasing power over time. Monitor geopolitical developments. The financial strategies of BRICS nations are deeply intertwined with geopolitical dynamics. Staying informed about these developments will help investors anticipate market shifts and capitalize on emerging opportunities. Adopt a long-term perspective. Precious metals are not get-rich-quick schemes. They're about preserving and growing wealth over the long term, particularly in an era of economic and political uncertainty. The integration of gold into global financial systems marks a return to fundamentals. For decades, fiat currencies have dominated the financial landscape, backed not by tangible assets but by trust in governments and central banks. As that trust erodes, gold and silver are reasserting their roles as the bedrocks of monetary stability. The rise of BRICS Pay and gold-backed digital currencies offers a glimpse into a more decentralized and equitable financial order. These systems empower nations to conduct trade on their terms, free from the constraints of Western-dominated institutions. For investors, this shift underscores the enduring value of precious metals in a changing world. As Andy Schectman emphasizes, the time to act is now. The ongoing accumulation of gold by central banks and the rise of non-dollar trade systems signal the dawn of a new financial era. By understanding these trends and positioning themselves accordingly, investors can safeguard their wealth and thrive in the face of uncertainty. The words of economist Friedrich Hayek come to mind. I do not think it is an exaggeration to say history is largely a history of inflation, usually inflations engineered by governments for the gain of governments. Gold and silver offer protection against this engineered inflation, providing individuals with the tools to preserve their wealth in a world increasingly characterized by financial instability. For those willing to adapt, the opportunities are immense. For those who cling to the old paradigm, the risks are equally profound. The choice is clear: embrace the shift or be left behind. The era of gold and silver is upon us, and the time to prepare is now.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.